Recycling. Recycling refers to the method of funding an ESOP participant's distribution using cash in the ESOP to repurchase shares so that those shares are immediately available and reallocated to remaining participants. Recycling shares is treated for all reporting and withholding purposes as a cash distribution. Now, recycling with contributions reallocates shares to active employees based upon their current compensation. And the most efficient way is to contribute cash to the ESOP based on repurchase obligations and required internal loan repayments.
Redeeming refers to the method of funding an ESOP participant's distribution in which repurchased shares leave the ESOP. After the shares leave the ESOP, they can be retired to Treasury, recontributed to the ESOP, or sold back to the ESOP. The total number of shares to be repurchased over time will always be lower when stock is redeemed, so the overall cost of redeeming versus recycling will depend on the impact on the per share value of the company's stock.
Prepurchase obligation. ESOP participants have the right to sell their shares back to the company, creating the company's repurchase obligation. The obligation is to honor the put option and the obligation to provide cash to the ESOP when participants exercise their diversification rights and take distributions in the future. The repurchase obligation grows as the ESOP matures, and the ESOP Administrative Committee should prepare a plan to address the normal demographic and other bubbles that arise as a result of the cash needs of the ESOP.
Rebalance. The mandatory transfer of employer securities into and out of participant ESOP accounts, usually on an annual basis, designed to result in all participant accounts having the same proportion of employer securities. This is an optional plan design feature designed to curb have and have not issues in a mature ESOP.
Reshuffling. Reshuffling is also known as segregating participants. This applies to terminated participant balances only. Once the account is valued after the termination event, all shares of stock in the account will be sold at that year's share price, and the balance will then be invested in a conservative account managed by independent investment managers. This ends the investment in company stock. Participants no longer see gains or losses as a result of future stock price changes. Instead, they will see gains or losses as a result of the conservative investment account. Some plan sponsors reshuffle or segregate so that terminated participants no longer benefit from employer stock appreciation when they are no longer at the company contributing to any appreciation.
ESOPs have unique tools that are available to them to help make sure that they're healthy and sustainable to create employee wealth. One of these tools is one of the 6 R's, Releveraging. Releveraging is the purchase by the plan sponsor of a substantial number of shares from the ESOP, followed by a sale back to the ESOP, financed by an internal company loan. Typically, this transaction would involve 25% or more of the shares that are owned by the ESOP. The company buys the shares from the ESOP. The participant accounts receive cash for the shares, which then can be thought of as pre-funding some of the future repurchase obligations. The shares that are purchased with the loan are released from loan suspense and allocated to participant accounts as contributions are made to the ESOP in subsequent years over a long amortization schedule, typically 20 to 30 years. This helps manage the allocation of shares in the future and prevents a have or have not situation. This is Shannon Maloney, the ESOP Queen.